Good evening, guys. Ken at Tortoise Capital with the review of the strategy report for August 11th, 2020. And today we finally had the first big crack in the upward move of the last 10 days. And we mentioned yesterday, that the size of the daily legs downward were about this size. And that's the size of the move that we got today, which was about $6, so about 2%, which is almost 2 full ATRs in net negative performance from high to low. Yesterday had been the sixth day of just uninterrupted gains. And today started that way with a nice gap up of about, a third to a half of a percent. It pushed to a new 10-day high and a 30-day high at 338-ish, and then commenced to sell off the rest of the day and closed poorly after finding support at the edge of the dragon. So really the largest range of the last 10 days, and it was selling pressure, which was against the run of play, against the primary trend. So that's not unusual when you start seeing the big move is the anti-trend move, that first move away from the strong trend. The trend remains strong, as evidenced by the strong upward slope of the 10-period regression line. But there are some signs of weakness that the slope of the 30 got weak today. So the 30-period regression line extension is now only about a 20-degree angle. The slope of the dragon extension is still up at a nice 45-degree angle, but you'll notice that there's very little buffer now between price and the spine of the dragon. That was not the case yesterday. And then the PSAR continues unabated, moving up its limit move there. Tomorrow, the PSAR's price will be about 328.94. So that's tomorrow's. The PSAR plus one. Today's PSAR was at 327.80. So that moved up about $1.20-ish. So the long upward trend remains in place, but you'll notice that even the Bollinger Bands are starting to roll over and converge. This is the sign, more like it's closer to the end of the move than the start of the move when that happens, when the Bollinger Bands start to compress. Let's take the downside support levels first. So the dragon's top skin and the peak of the dragon is at 323.30. The low of the day, 331.96. So I would take 332 to be an important round number. And it closed 80 cents above that at the price. Spine of the dragon at about 331. The Z1 at 329.8. The PSAR plus one tomorrow there will be 328.94. The southern skin of the dragon, 328.4. The previous peak of the RL10 was way back here at 15 days ago at 326.42. Then there's a big gap once you get out of the dragon all the way down to the peak RL270 fair value 323.45, and then the Bollinger Band mean at 322.56. The 10-day low is at 319.64. That will be tomorrow's 10-day low as well, and then that is going to ramp up tomorrow to about 321.8. this will be in 2 days. The 10-day low is going to be here. That 10-day range is 5.37% from the 10-day high down to the 10-day low. And it's important to note we did make a new 10-day high and a new 30-day high today. To the upside, we'd be looking at it has to get through the peak RL90, which is here at 333.8. And now there's this cluster of this intersection here of the baby dragon, the RL10, and then the moving RL10 price all rolled over here at about 336 even-ish. So that's going to be strong resistance. And then the peak of the RL10 at 336.5, I think, is really the strong resistance. And then the 10-day high and the high of the day and the 30-day high up here, 337.66. So unlike, I just want to take you back, the last time we had a move of this magnitude, like a $6 range move, was back here on the previous Friday, 2 Fridays ago, when we had a move that gapped up, sold off, and then had an intraday rebound to bring it all the way back up to close strongly. Well, today it was a move of that magnitude, but it was all down, and there was no joy in Mudville. Even the defensive plays like silver and gold got crunched today. I think that's going to be an interesting trade tomorrow. Price closed, from the 10-day high to the closing price was about just about 2% in the sell-off there. Now, if it can push through the 10-day high and the high of the day and the 30-day high, that there's really no resistance overhead. And so the peak price in the dragon of all time, 339.28, from about 5-6 months ago. That doesn't feel very realistic to me. But what this really says was there was a moment here just after the open when it got about as high as it had ever gotten statistically. If we say the hump of the dragon is the statistical turning point, that peak dragon peak all time, 339.28, is where it got to at the peak before the COVID sell-off. So that's what this last run up had done. In the last 10 days, it had closed, it had made that final move up to that peak, and then the rest of the day happened. So this could very easily be the climb up the stairs, jump out the window kind of a trade. So if tomorrow we get a move of the same magnitude, how far could that get us down? That could get us all the way through the dragon and all the way through the PSAR and into this soft, no support levels down in here until you get really to about the Bollinger Band mean. So that could be an additional 4% move down to the Bollinger Band mean. So not optimistic at all. All right, so let's take a look and see what worked and what didn't work today. All right, I inverted the tables to show the weakness at the top because it was that kind of a day. So we have the S&P here at minus 0.8. We had the diamonds were slightly better at minus 0.3. The Russell was slightly better at minus 0.58. So let's take a look at the things that were better. Yeah, so the S&P at minus 0.8, healthcare minus 0.6, Brazil and the Russell minus 0.6, getting better all the time here now. Diamonds minus 0.3, and we had a nice cluster in here between minus 0.3 and 0.2. We had energy, emerging markets, materials, and consumer discretionary. All held the line a little better. And that was consistent with yesterday. So yesterday was a gain day in which the non-techs had the strength. So today, the non-techs preserved or minimized the losses better than the techs did. Getting into the green, we had Home Depot slightly in the green, Caterpillar 0.36, Coke 0.44, Japan 0.8, Mexico 0.9, Finance XLF 1.1, Simon Property 2.6, and then Wind Properties plus 8. That looks to me like it should be getting vulnerable now for a swing short. Can't understand the reason why that's up. Nothing in the economy says that Vegas ought to be doing any good. The bigger story was what was bad today, what led the way during the sell-off. So the S&P there down minus 0.8, Treasuries down 1.2, tech and oil exploration down 1.64, 1.8, clean energy down 2.5, the triple techs down 5.5% each. It didn't matter which one you had, TQs or TECO. And then the crucial speculators here, Kodak down 6.7, Wheaton Precious 6.7, Nikola Motors off 8%, and then silver down 13.5%. So that's some of your defensive plays for you right there. Holy smokes. In the companies, the tech companies that were worse than tech was Intel minus 2, Amazon minus 2, Microsoft minus 2.3, Facebook minus 2.6, Nvidia and Apple minus 2.8 and 9, Tesla down 3 and some change. And some of the metals, you had Nucor Steel down minus 1.5, U.S. Steel 2.6, Alcoa minus 4.3, Virgin Galactic minus 5. So this was just a consistent day for that for this kind of fragile market condition in which like I've said, my core positions are off the table. My swing trades are limited to those that have earned money intraday with a turbo when I keep a piece. I'm going to show an example of that with Caterpillar today. And then really it's just taking one-day directional trades in the direction of movement in the biggest movers of the day. There is, I want to reinforce that lesson. There was a question of me, I think, was Joe in here today? Yeah, Joe's in here. So Joe asked a question in the chat room. Let me find it here. And this is a good question for a guy that's recently taken and is taking the hybrid course and still working through some new ideas. Let me find So Joe's question is, he's getting hung up on the fundamentals. He looks at a cheap stock like Kodak and fears the loss of financing could be the end of them. So he doesn't want to go long. I don't mind you not going long on that. I don't have any reason to go long. I look at the stock like AYX dropping 40% on an earnings beat with level forward guidance. Wonder what we don't know. And so a question he's asked me for Saturday. Both look tradable. I'm going to say don't trade them. It is rare for me to trade these story stocks. I mean, 80% of my trades are in big, fat, mega cap companies and big, fat ETFs where they are very liquid and there's a ton of statistical legitimacy to studying their technicals. And they are not story stocks. They're the opposite of that. That's how I'm trading these techniques. And so his question for me was, how much do I look at the fundamentals prior to or along with looking at the charts for either intraday or swing? And here's my answer. I'm going to try to be as clear as I can be. I don't look at any fundamentals, none. I don't have any edge looking at fundamentals. If you take a look at the number of MBAs that are produced every year and the PhDs of STEM that are hired by investment banks to do fundamental analysis, and you take a look at the supercomputer power that goes into hundreds of thousands of analysts doing fundamental analysis full time with supercomputer support and with the advantage of insider trading information, that's who's doing fundamental analysis. Now, if I take a look at my own assets, I say, maybe I think there's some value in fundamental analysis. In what possible world do I have any conceivable edge compared to the vast array of fundamental analysis and insider information that's out there? None. I don't have any edge when it comes to fundamental analysis. Now, if you want to try that, all you got to do is tell me. I would just ask you, why do you think there's an edge with fundamentals? And then you tell me how you would incorporate that edge into a decision about price action. Because price action on 1-minute charts and intraday trades has nothing to do with fundamentals and has everything to do with tactical trading and psychology. My approach is exclusively statistical, technical, psychological, and managerial. Those are all the places where I believe I have an edge. Let me say it again. Statistics, I have an edge because most people are afraid of math. And most of the statisticians that use statistics that I've talked to, dozens, not that many, but to be fair, professional statisticians almost overuse statistics when they're trying to project and forecast their insights. They're trying to get inferential statistics. I'm just using descriptive statistics. So I use a very limited, narrow approach to the application of statistics. It's still enough to give me an edge against non-mathematically inclined herd animals, but also against statisticians who put a certain belief and confidence intervals into the forecasts they get when they do inferential statistics. So that's an edge that I believe that I have and that I am trying to exploit in a particular way. And I'll cover that in a flashcard. The second edge that I have is in technical analysis. And the edge comes from using technical indicators that I've either created myself, so nobody else is using them other than our little community of practice. So I'm getting a technical look at the markets that most other people don't have, and I believe I'm operating in their blind spot. And because it's technical, I understand the limits of it. I don't try to overfit the curve, so I have an advantage in how I use technical analysis. Like I use Bollinger Bands different than the millions of people that use Bollinger Bands. They use the default setting of 20 and 2, and I have different application of Bollinger Bands in the way that I use them. So even when I'm using technical indicators, I'm using them maybe in a different way. So that's an edge. I have a psychological edge because I'm a combat veteran and I've been shot at by professionals for a living. And I know how to manage my psychological state when it comes to trading. And that gives me an advantage against herd animals who don't have the same commitment to managing their own psychology and who aren't using psychological insights as reflected in price uh, to frame decisions. And then finally, I have a managerial approach to systems and strategies and positions and my own performance that involves non-Western continuous improvement techniques. It avoids the belief in perfection. It looks only to improve managerial processes with the law of large numbers. So all four of those elements, I believe I have a very specific edge in each one of those, and I combine those four areas in order to create a compound edge for the way that I trade. I try to reveal that to you in the way that I'm doing things, but I don't have any edge in fundamental analysis. In fact, every time you see me trying to make estimates of earnings or whatever, I'm always wrong. So I don't even try to do that. Not seriously. You've never heard me or seen me use fundamentals when it comes to framing a trade or tying it to a very specific decision point, other than to say, hey, there's an earnings announcement coming up, so I'm going to get out of the trade just to avoid it. So fundamentals do not appear in any of my rule sets, in any trade frame, in any kata, or any flashcard. 80% of my trades are not in the story stocks like Kodak and AYF, but rather in big fat symbols of the Dow or in big fat liquid mega cap ETFs. There are only a few notable exceptions, which are symbols that are in play that have a very unique role to play as representatives of their sectors, like Cliff Natural Resources and Wheaton Precious Metals and Simon Property Group and Virgin Galactic. But when I'm trading those story stocks, it's not on their fundamentals. It is exclusively on those four areas where I believe I have an edge: statistical, technical, psychological, and managerial. So my main point is know your edge and exploit it, and then verify it through performance. So in short, Joe, I don't pay any attention to fundamentals, and I'm not trying to use my framing techniques on things that I have a fundamental opinion on. I just don't do that. The closest I would say I come to fundamentals is when I say things, you hear me say things like, I don't know how you don't buy Apple at these prices. And even that's not even on fundamentals, but it really was just, hey, this is a company, a tech leader that's got the best design shop in the world, that's been making all the right managerial moves about COVID and just had a 10% sell off. How, as a hedge fund or a mutual fund manager or a pension fund manager, do you not buy Apple on 10% sale? I mean, that's a psychological insight, a technical insight, a statistically significant insight that a 10% sell-off was a large sell-off in Apple. So that's where my edges are coming from. Nothing to do with fundamentals at all. Nothing. None. All right. Let me get back to business here. Okay, let's take a look at let's go to trades of the day. Some of the boys had some good trades today. See if I can find them in here. Okay. Yeah, okay, so here's, I think this might be Joe. This is EWZ on the 1 minute chart. I like the hybrid frog short here. That's not bad. I think you might have elected, let's see, let me get my little sketch pen going here. Okay, so this is looking like the hybrid frog box here. Okay, and really this is almost like an OR5 breakdown as well. So I like this short. I think 1, 2, 3, 4, 5. I think probably with 5 bars in a row and it gets back into here, I might have taken that exit and just said, you know what, nothing there. Especially if you had this much, if you had a hybrid frog box gain in hand, the hybrid frog is supposed to trail. And so this would actually, the hybrid frog, if you're trading the technical rule set, would get you out right about there. I actually wouldn't mind this or this as a reversal to the long side, because you had a gap up, the sell off held above, it held above the yesterday's close, so that's a good thing. So any of those might be stop and reversals, supported spring crossings, if you will. And then with a peak up here and an exit probably over there, you probably make a fraction instead of losing a fraction. For those of you studying the supported fall crossing, there it is. And it comes right back to the low of the day. So that's a good supported fall crossing with a nice tight stop here. And then just kind of the Wu Wei exit gets you out like in here. This would be a 1, 2, 3 exit. There's the 1, there's the 2. It opens and then takes out the high of bar 2. So that would be a 1, 2, 3 exit. Start with the earlier, I guess the earlier IYR. Yeah. All right, so I want you to notice an RL10, RL10, RL10. So 1, 2, 3. When you see that pattern right there, where you have that lower highs, you get this kind of action here and lower highs. That makes this the best SFC that you'll ever see. And in this case, with a stop here and then probably an exit here, you're going to make a little bank on this. So this would be a pocket. This would actually be the collapsing dragon because it fell below here. So anything in here is a collapsing dragon. And then with this as your stop, the Wu Wei exit, I want to show you the Wu Wei exit on this because it'll just make you sick. So I guess you could, here's one. If you're using the dragon, you have a 1, 2, 3. And now notice how this hump of the dragon is lower. That makes this a pocket. And that makes this the collapsing dragon. So I'm going to infer that the PSAR dot was like right here. So the Wu Wei exit says you keep that in place until the PSAR dot, till you get 3 or 4 of them past the entry. So at this point, you then drop this down here and you keep that in place until the Bollinger Band mean comes in. Then you follow the Bollinger Band mean and you get out here. So the first one, you get paid that box. Then here's the next one. Let me show this again now. And now you have 1, 2, 3. This thing, it went down and over and started to fail again. So right in here, that is screaming for a CD. It's a low of the day. And now your stop is here. And then when this gets about 3 dots past your entry, you drop that down to here until the Bollinger Band picks up. And there's your gain to here. That now makes this a harsh winter. I think you would agree. You could even have a second position here, by the way, because you had 1, 2, didn't even get through the dragon, and then down. That's another CD. So that's a second entry. And then on that one, you'd probably exit here because you had 2 positions in hand and you're getting in towards lunchtime. So why not? So now I have a harsh winter. I have a low. I have a higher low. So here is your supported spring crossing entry. You say, well, Ken, what about this one? Yeah, but I don't mind if you take this one, it's before the PSAR flipped. But if you take this one, look at the price is declining, so just wait. So you might have taken that one. No matter what, the PSAR stop is never hit. Your Wu-Wei exit is never hit. Come on, damn it. So I don't care which one of these entries you take, whether it's this one, which I don't like. I don't mind that one, and I love this one. All of them, whether it's this PSAR dot or that PSAR or this PSAR, all 3 of those work very nicely on the Wu-Wei exit. Let me draw those correctly. And you'll notice that they're all about the same when it comes to the price that you actually get. So now when I just bring that over to here, so now I have about 3 dots, 3 PSAR dots above my entry. So my exit, the Wu-Wei exit now comes over to here, picks up and keeps it at that price level until the Bollinger Band mean catches up, and then the Bollinger Band mean takes that exit. And I don't mind at all. That sniper exit, I think, is outstanding. But what you'll notice is that gets you an extra. That's almost the size of the gain. So that's the SSC right there. The third one at least has the advantage that it's above the 0 line, and now it's actually in the summer. Here's the trade I want. The collapsing dragon. My favorite pattern. And really 2 of them. All right, so the thing I want you to notice, okay, so now this is Joe again, I think. So here's 12 o'clock. This thing is going into a sideways quiet channel right here at lunch. So that's noon. At noon, that thing is starting to compress. So you've got some compression in here. You've got a real Z3 pinch here. Second position. Probably a sniper exit or a Wu Wei exit. Either one of those is you're gonna be very happy. Now, I don't mind this. I like this as a re-entry. That's fine. I don't mind the scratch there. The trade I want you in is this one. Initial stop. I get about 3 dots past my entry. That's when I bring the exit down here. Leave that in place until the Bollinger Band mean picks it up. Now, maybe that gets you out, but if you're following the rules, it doesn't. And you get out here. You might have picked up a sniper exit in here. You might have picked a sniper exit there or in here. I don't care. But this is the trade that I want you in, and that's the trade I want you in. This is okay as a re-entry. So if you were long 1 or 2 positions, you got out, then this is a nice re-entry here. Maybe this is a little too high, but this is the nice re-entry here, and that's not a bad scratch or a little capture. But that's the trade I want you in. These moves after the range compression occurs, those are the big moves. When you get range compression, then expansion, then that's leg 1, and you have every reason to believe that's going to be leg 2 because now it's 2 p.m. and you're expecting this thing to go, but it didn't. XLK. So I'm noticing the RL10 and RL10 double bottom. I love this. I love that. And that's a really good exit. When I see this low and this low, I want this entry here and not that one. And then the Wu Wei exit says, keep this in place until you get about 3 dots above this, then move the stop up, and then you end up picking up the Bollinger Band mean or the PSAR, whatever you're going to do. You might have scratched here, but keeping this initial thing in play gives you some room to let this thing wiggle around and decide what it's going to do. Then when you see the Z3 excursion, this is a place you could then add a second position with a stop here, because that's the same size stop as this, the same size stop as that. And then notice that this Z3 excursion line connects to the top of the hump of this dragon. So whenever those measures, whenever those statistical boundaries, like this, when those statistical boundaries are violated, that's like the releasing of great pressure. So that makes this a really good entry or a second entry or a re-entry. Here's SPY. All right, so this one I'm really liking. I'm really liking that one. You could have gotten this, and then this might have scratched, but it looked to me like you played this, and then it's starting to roll over again, so you get the short here. I love that. Again, so your stop is going to be right here until you get about 3 dots past your entry. Then it drops down. You keep that in play until the Bollinger Band catches up. And then this probably gets you out right there, or maybe here. But that's a really good entry because you can see how this belly of the dragon, all of those got violated by that price there. In the same way that if this price here had gone through this, this would have been a long position because you're breaking above the top of the dragon. That would be a long. But that's a good trade. I'm not hating that. Here's XLE Energy. Harsh winter. This entry is about, if that's a full frog box from there to there. So this is at about 0.3 of a frog box off the bottom. That's very well done. The piece or the Wu Wei stop would have kicked in right about here. You come to here, and then that'd be the managerial exit. I love the sniper exit. I love the keeping. You gave back 1/3 and you kept 2/3. That's not bad. You know, on any given gain, if I can keep 2/3 and give back just 1/3, I feel like I've given it enough room and I've kept the bulk of it. That always feels good as a psychological state. What I would be looking at 2 o'clock, I would say, here's a low, here's a low in the dragon. I'm now very interested in this going long, and then if it gets above the dragon and the hump of the RL10, that's probably where I would add a second position up in here. But I would be looking at this with a stop right about there. Back earlier, here's a peak. There's a lower peak. That makes this like a collapsing dragon right there. So that's shortable with a stop here. You could make that gain. And then that becomes a harsh winter. And here's the PSAR flip. There you are. And then right about here, it comes up. And you might have gotten out here, or you might have picked up the Bollinger Band mean and gotten out here, or taken the sniper exit. But on this harsh winter, you wouldn't lose money on that trade. And then you might have tried a re-entry here. So this whole segment is tradable, and then certainly this whole segment is tradable. Collapsing dragon, especially when you see the RL 270 peak and start to roll over. Yeah. This one, when it made a new low of the day, possibly 2 positions, even 3 positions short. Some good possibilities there in energy. Very liquid, very tradable. Here's a trade frame in Alteryx. So I don't know anything about them or the size of them. I'm looking to see what is the, so this is a 30-minute. I would ask you, use the full size of the paper and then uh, make some room there. I don't mind this at all, though. I think that that looks tradable to me. Hang on. So this is the turbo trade on this one. Sorry. Um, yeah, this is this is probably like a super pinch or at least a Z3P kind of action in here. Look at the distance between in the PSAR flips is so small. This one to me, you got to be able to play this as a trading breakout. There's no tactical reason not to. Um, but I don't know that there's enough room in the trade to make this thing really go. This looks like a story stock it doesn't have a lot of volume and big swinging moves that we can frame. This is really, well, this thing is basically sideways and it could break in either direction, and you've picked sort of the minimum manageable risk box. I think you just put something on that. Yeah, like you've shown, hold your nose and try to get to no lose plus dinner for two, whichever way it breaks. So, I mean, that's I think the only way I can see to play that, if you've got to play that. This is Altera on daily charts. Um, oh no, this is the turbo setup. Okay, yeah, I wouldn't disagree with that. Yeah, because if it gets out of the yellow zone, it's made a clear directional move, and it could easily get to the top of those, to 112 or 113 on an intraday move. That's certainly tradable. Let's take a look at that one tomorrow. 10-day high is 185. Oh, is this the one that got smashed on the earnings? Okay. So you're playing a technical rebound on that one. I usually like to give them a couple days and see that they bottomed out before I go for it. But let your conscience be your guide. Here's a real nice one. This is from the trading kata. Perfectly here's so this is what you get when you use DIA instead of a story stock. Um, Perfectly executed supported spring crossing, perfectly executed Wu Wei exit, 2.2 execution R, right by the numbers. Brazil, this is that lunchtime play. That was tough, but that's a reasonable shot, and we already mapped out the getting the supported winter crossing or the collapsing dragon move. So, but that's correctly executed. But if you're going to practice the kata, I would practice it all day. And I think you're at the position where you could start looking at collapsing dragons too. So good work on there. I respect the fact that you're doing the work. Well done. Um, let's go to the daily report. Okay, we've already seen the health check. So let that come up on your screen. Stand by. All right, let's hustle through the daily then. Frustrating. Still normal. Still well overbought on all the long-term indicators, but you you can see the short terms have picked up today. The magnitude of today's sell-off. Still a strong or becoming stronger on the ADX, I should say it that way. Risk Z is at normal levels, so there's still the good possibility of some swing trades. And today's actual sell-off may actually create some conditions for buying on dip opportunities if we play it correctly. So I am now more interested in playing the long side swing trade than I was before. I'm certainly interested in playing the short side swings, given the tremendous runs of the last 10 days. The things that led the way down today: Microsoft, Boeing, Walgreens, Pfizer, Chevron. The big winners for today, the ones that held off most of the selling: Procter, McDonald's, Coke, Johnson and Johnson, and Home Depot. It's telling that there are zero tech companies in there. Those are all kind of the traditionals. Dow Tactical Summary. Um, Again, weakness in Microsoft, Intel, Walgreens, and Apple. So Apple has to be of interest. It's down 3% today, but has been outperforming everywhere else. So it's got to be on our list as an interesting symbol. This is looking like the beginning of a buying opportunity back in silver. Some good auto framers now are setting up Brazil, Latin America, gold and treasuries. I like that gold and treasuries are going to be good as defensive plays, combined with this sell-off today. Now here's a chance maybe that the defensive plays are going to give some reward. So that will bear watching. In the auto framer, we'll go next. Those four, let's see, gold, treasuries, Latin America, Brazil, and Microsoft. You should be able to see here in a second. All testing out better than 2-to-1 on the auto framer, I should say. And then the column under my risk tells you what that swing recommended risk level would be for the initial position. There were no squeezes available today because of the size of the range. Chevron is in the winter, and energy underperformed somewhat today, so that would be a candidate for some possible shorts. And then I think Brazil, weakness in the fall. Amazon, Microsoft, Walmart. It just, man, opportunities for value plays inside there, I think. See the magnitude of silver and gold's sell-off today. Treasuries is the anomaly to me. I'm surprised at that, unless that was technically running the stops to see who they could shake out of their positions. I still like treasuries long term between now and the election. So today's little sell-off is just still in line with the rest of the move. It's just that it feels weird because that was 8 days without a sell. All of the other previous selling days did not feature pain and suffering that followed through. So we'll see. The only issue of concern is that now we're right near those previous levels. And if you look at the last time we were stretched that much, there was a big sell-off. So this one could get us down, back, 5 to 8% sell-off there. Abnormally quiet. So these, I've been saying for a couple of days, the possibility for a volatility spike is certainly there. Okay, so that's pretty straightforward. I do want to cover the flashcards. I did up a couple of flashcards. Let me see if I can get the other one uploaded for you here. Okay. All right, so I've been drawing this freehand 3 or 4 times in the last couple of weeks. So I wanted to get it cleaner and neater one time correctly so that you have a nice reference document. Okay. And I want to talk about this in terms of what feels like the eternal struggle between buyers and sellers on your time frame. Who's going to win in the tension between buying and selling, bulls or bears? I just want you to remember that whatever time frame that you're on, what feels like a real clear-cut buying and selling tug of war for you is just noise on the higher time frame. All of the existential suffering that you're doing is on the higher time frames. That's just noise within the same candle. It's noise until you trigger their alerts. So if you're able to actually see a clear-cut victory on your time frame, well, all you've really done is triggered them for an alert on the first leg on their time frame. So it feels like a massive win was really just the first blip up to the higher time frames. So I want you to think about there is some moment in the trade when there was a really strong move and you had the Z3 lines diverge, but then it starts to consolidate in and around this very narrow range in here. Okay. So while the Bollinger Band lines got very extended, at some point price starts converging here until you get about 10 bars in a row and everything is inside the river and the river is approximately flat, and you can start seeing those Bollinger Band lines compressing and collapsing and coming towards the center, and everything is horizontal. So by the time you kind of make that recognition, the easy moves are over, and we are now in By this time, we're probably in the Red River of Crocodile River. So you don't want any part of that. Crocodile River is where you get all chewed up. Until such time as those Z3P lines compress, so as they compress down to the point where from Z3 to Z3 all fits, so from the Z3 line up to the Z3 line all fits within a single frog box. And then you've picked up the Z3 pinch, and now this thing is back to tradable conditions. Hooray. And at this point, we're ready to trade, Z3 breakouts. In some cases, you might even be tempted to front run that with like a Z2 breakout, at the edge of the floodplain. Or you might see something like a fake one go to, where you have something like price is just cruising along here, gives you a quick move down, and then that reverses to go up. And you sort of have that fake one go to. That's not unusual for that to happen. Okay. So what I want to say is, let me just take the easiest one to see of all, and that's just this Z3 breakout and collapse and go. What happens here is, instead of the buying pressure, there's some amount of buying pressure and selling pressure that's somewhat equalized. That when it's in that sideways quiet channel and then the Z3 pinch, you have somewhat balance of power between the buyers and sellers. Neither one can push the other one around. But then you get this breakout from the Z3, and that's sort of an indication that, statistically speaking, something unusual just happened at that moment. That this was different than all of that sideways tension where buying and selling pressure was equivalent. And now all of a sudden you've got, 3 sellers coming in for the buyers. And in this case, the buyers lose. And then what happens is the sellers win. And these guys are of the opinion, a short early, short often, don't wait. Oh, it's too late. They want to hurry up and get in and overwhelm this and really drive it down. And when that happens, you see that great big harsh winter. And what really just happened there was the failure alerts buyers who now want to buy this quality on sale. So there's all these other buyers that are just kind of waiting down here, like sharks ready to pounce. And on that first leg down, the sellers won, and they drove it to a level at which the buyers say, oh, I can now buy quality on sale. That's awesome. And so now down at this critical state, there's kind of a decision. That is, now are more buyers or more sellers going to come in to keep pushing this thing down, or did all the guys who were interested in short it, they already got short up here, and now by the time it's come down this far, they've already won, and now they're more interested in preserving the gains, their ill-gotten gains that they made, than really trying to push it any further, because they're of the opinion short early, short often. Don't wait. Don't wait for confirmation. Crush it while you can. Induce a panic. And meanwhile, the very fact that there was a failure and put this thing at a more favorable location to buy now attracts this buying pressure. And now it's 3 buyers for every seller. And now, instead of failing further, this thing just goes sideways. And then we may actually see that may actually bring in more buyers, because now you say, oh, failure to fail further brings in even some more buyers. And then, while the sell-off is normally characterized by that sharp leg downward, we're not surprised when the legs up take leg 1, grind, leg 2, grind, and leg 3. We might have projected some kind of move back previous fair value, right? We might have said, look, the previous price level where buying and selling was normalized, and maybe the VWAP is up here, that's the previous fair value. And unless, except for those tactical traders, that's really where the fair price is. So now maybe there is some time decay, that's triggered by, as people are looking at this big sell-off, they say, maybe those guys actually know something. And the longer that it takes to recover, the sense of that fair value begins to decay. So there's perhaps some time decay in that, and that's fine. That's normal. That's sort of like that declining RL270 rolls over and starts to decay at a certain amount of time. So this is the essence of that supported spring crossing, is that we're getting in on kind of the minimum mission essential time to get long, and we have a pretty tight stop in there. Down to our little PSAR, if you will. And we're aware that this thing may not rocket straight up the same way that it came down. It may take leg 1 or leg 2 or leg 3. So we're going to manage that. But what we got to be mindful of is that when we see this thing grinding up or rocketing straight up, what that really reflects is that there's more buying pressure than selling pressure. But what I want you to remember is that each level up that this thing goes, while it feels like the buyers are winning on your time frame in the struggle, that's noise until it gets to the higher time frame who says, hey, we loved getting short on this thing way up here. That's why we crushed it. And we made our money on the way down. And we were happy to sell to all these knuckleheads that were buying it down here. And now those guys are long from down here, where they made it turn. And then the further up the stack it goes, there's less and less money to be made. And all you did was, your very success in retracing it was you're alerting the sharks to come in, and now they want to start punching this thing to the downside because they see this as a short on a dead cat bounce, because they're playing long, or they're playing big short, small gain, and then getting short again. So they want to play it this way. If they can, they'd like to get short in here, or short there, or short from there. So what price retracement that you feel is success and a validation of your belief, at some point at the next higher time levels, all that is it's noise until until this thing moved up high enough to bring in that wave of short sellers again. And so the power of the prior trend, that's what I want to say here. The prior trend crowns the winners And then that becomes the dominant move, like this big downward sell, until the contenders can come in and then they can push it back above this price level. Then they've won. But really, the power of that first trend, until proven otherwise by taking that out and negating the original big sell-off. So I want you to just remember that what feels like this eternal struggle to be right or wrong on your time frame is really just noise on the higher time frames until you triggered their alerts. That's why that 2-hour battle drill matters so much. In fact, what if you were successful and you got that supported spring crossing and you pushed it all the way back up to fair value? That's the same price level where these sharks came in and shorted it the last time. So don't be surprised that it gets that high. And then those guys get activated, and then they come in and start crushing it down again. Guess who doesn't care? All these guys who bought down here, they made their money. By the time the shorts come back in to start pushing it down, these guys have made all their money. So the longer you wait, the less gains there are until the sharks come back in. So at some point, you have to be able to act as the second mouse with just enough information, with the smallest manageable risk box, because your job in this statistically driven scenario remember that your job is to have your stop in place and when you buy it, and then how quickly can you get that to no lose plus dinner for two, and then pick up the sort of that Bollinger Band or sniper exit combination so that you're not losing money on this. Like, you got no idea at the time of entry, you got no idea back in here how far up the stack that's going to go, and if is it going to get beyond the previous support level and take a second leg up. There's no idea in the beginning what the probability of that is. There's no way you can know that. All you can do is take your shot and then get your risk out of there and then just manage the position. So there's nothing fundamental about that. That is all technical, psychological, statistical, and managerial. That's the only thing that is. But that plays out so many times that you'll find that to be a way to preserve your sanity, and it relieves you of all of the cognitive effort of trying to figure out what are the reasons why. Why are those guys making those moves? It doesn't even matter why. Even if you knew why they were doing it, they've already done it. What about the next guy who hasn't moved yet? What's going to make him move? You don't know. So once you start down the pathway of trying to figure out why things are happening, there's no end. So that's what I wanted to say about this one. The eternal struggle of on your time frame is just noise in the higher time frame. So you can download that one as the 3 legs. The next one has to do, this is related to it kind of in the same way. That on my time frame, I've told you about how my professional space is between -1R and +2R on my time frame. All right. And so the 3 things that I look for, first, no losses greater than 1R. Then 2, I'm looking for that normalish looking curve between -1 and +2 a normalish looking distribution. And then 3, I'm looking out here for the possibility of fat right tails beyond 2R. But I want to be positive expectancy in my professional space between -1 and +2. So I'm fighting for nickels inside there. But I also have this belief that from extreme conditions come extreme results. And that's why I like having that critical state, because then the chance of getting those big moves in short periods of time is increased. So I would just call this my professional space. But if this is on 1 minute charts, on the next higher time frame up in here, if I were to plot the size of my moves on his time frame, something that earned me like 3R, or maybe even 2R, I guess. These moves that are really wonderful for me on my time frame, on his time frame, that was just a 1R move. You know, from here out to here for him was just +1R. That's not even beginning to be exceptional. So if he just cashes a 1R win, what that meant for me was I had a trade that moved out to 2R and beyond, and I got a little piece, and then it stopped and reverted back. And that's as far as it went. But once in a great while, 1 out of 20 times, his move goes past 1R, and he's going out to his 2R battle drill. And that becomes his fat tail. Well, if I'm able to get multiple positions in on mine, then this becomes a really amazing big win for me. If you look back through the last couple months, you've seen there have been those occasional moments when we've gotten 10, 20, 30, 40R on a trade series. That wasn't because we were smart that day. We were just doing the same thing we always do. It just so happens that the next higher time frame, and maybe the one beyond that, all decided that they'd gotten out in here and they just kept buying and kept taking it, and we got swept along for the ride. Well, there's nothing in our time frame that tells us that that was one of those moments that they were going to do that. All we can do is manage our risk properly in the space between -1 and +2, lather, rinse, and repeat, and get lots of trade opportunities. And every so often, one of them goes beyond 2R, and then every so often, one of those goes into greatness on their fat tail. So I want you to see that 2R is really the gateway to a fat tail for us, and then a gateway to their fat tail, which is when it can really become extraordinary. And I'm not taking losses greater than 1R. What I am doing is that when things where I might be taking a 1R loss probably are leading to collapsing dragons in the other way. And so, my gains are also going to kind of be out this way, out to a 2R battle drill on the collapsing dragon. So it's not like I'm neglecting that side of the curve. It's just that I'm not sticking around. I'm more likely to have stopped and reversed or picked up the collapsing dragon. So one of the reasons that we do the multi-time frame, multi-lens analysis is that we want to know where their price alerts are. Like what's the weekly breakout, or the 10-day high, or the 30-day high, or the 2 or 3 ATRs or something like that, because we're trying to imagine those decision points where we wouldn't be surprised that they took action. So in general then, when we're trying to frame a critical state, all we're trying to do is we've seen some kind of amazing trade frame, some kind of trade result already. Some previous move resulted in a tight little doji in a perfect world. And now the possibility of a large move in either direction is equally likely, and it'll happen fast. And all it's done is just paused. Where we are right now is the pause. So I do not have a directional bias. All I know is that when it breaks out of the yellow zone, it could go to some previous reasonable price target. And when we go through the trade framing process, I may want to go this way, but I'm also ready to trade framing process. I may want to go this way, but I'm also. And so the trade framing process requires us to look at both sides of the trade. And the rule of thumb is that after these critical states, we're expecting big, fast moves. Quick, fast, and in a hurry. Big. It's either going to be a reversal, like it was a sell-off doji and then a reversal, or it was going to be sell-off doji continuation, where leg 2 is the size of leg 1. So the size of the move out of the doji is the same size of the move going into the doji, because it's symmetrical that way. And our belief is that from extreme conditions come extreme results. So now when we take it over to the specific SSC, we need to see that harsh winter, failure to fail further, PSAR flip, the thing takes off. So we enter, and then we get to no lose plus dinner for 2 quick. And then it's a science project. And then we hope that it goes all the way up to do a 2-hour battle drill. And then we can take action in a standard managerial way. So what I'm trying to say on these last 2 flashcards then is don't forget that those higher time frames are looking at your time frame just as if it's noise. And you want to know, where are their alerts and what's the evidence that their alerts were triggered and they're coming in, as in suddenly these short moves that we're accustomed to suddenly just keep going. So you can't be surprised when that happens. You just can't predict when it will happen. And today may have been that first alert to selling pressure that we've seen in 10 days. So there could be a big move down tomorrow, but there could equally likely be a big retracement tomorrow. What we saw today was a 2 ATR sell-off on a single day for the first time in 10 days. And now price is down here, and we can construct that nice tight 30-minute doji action or minimum manageable risk box. And right from the open, we're prepared to say, retracement back up to the 10-day high. Oh, nope. Continuation pattern all the way down to the Bollinger Band mean. It's a coin flip. It is exactly a coin flip in my view. I got no fundamental opinion, but I know how to follow price, and I know how to get my risk out of the trade through the use of the no lose plus dinner for 2. That's what I want you to concentrate on the rest of this week. So that's everything I got, guys. We'll get this published and posted, and sorry for the disruption earlier in the middle, but the replay link will have all that stuff chopped. So the flashcards that are clean are in there for you to consider, and remember where those edges are: statistical, psychological, managerial, technical. Those are the 4 domains of edges that we have. Okay, that's everything I got. Thanks for your kind